Hello, this is Linda Keith, and I am following up on a webinar, 60-minute webinar on global cash flow of tax returns when you have multiple pass-through entities in the mix. The next several questions are on 1040 Schedule E, and I want to read these questions to you because I made some pretty bold statements in the webinar. Should we ignore E2 completely? Do you utilize the Schedule E income reported in AGI, or do you get K1 to determine distributions, contributions? And what is actual cash flows from Schedule E income? Should we be focusing on distributions on K1 statements as cash from the entities? Well, should we ignore E2 completely? No, it's a great roadmap. It gives you the list. Here's the LLCs, here's the S-Corps, here's the partnerships. This is what you need to do something about. So I don't ignore it. I just don't use the numbers from it. We worry about double counting, but you know what? You won't double count if you don't use those numbers, and instead you go either to the K1s or to the full returns and do a percentage analysis. We'll talk about how to choose that one in a moment. So do we utilize the Schedule E income report in AGI? No. Get the K1s or the source entities. What is actual cash inflows on a Schedule E? None. It doesn't list cash inflows. It lists the share of taxable income from this other entity. And I'm guessing that you don't use AGI because it's not cash flow. Well, you can't use the numbers on the back of Schedule E either. They are not cash flow. Let's see. So it says, should we be focusing on distributions on K1 statements as cash flow in from the entities? Yes, or the full returns. And again, we'll decide that one here in a bit. Now, related to the 1040 Schedule E page 2 questions was the issue of passive versus non-passive. And I alluded to it briefly in the webinar, but let me give you a little bit more information on this. If you picture 1040 Schedule E page 2, then on your left are a couple columns called passive income, and on your right would be 3 columns that are under non-passive. The things on the passive side are investments. The owners are not actively involved in it. They're not making decisions. They're not running these companies. The ones listed on the non-passive side, the owners are active in those businesses. So when I'm looking at those two sides, I'm always interested in the non-passive side. These are the businesses they're running. They're more likely to have higher percentage ownership. They're more likely to have guaranteed debt on those businesses. And those businesses are more likely to be a significant source of income, either actual or cash flow available to these owners. Sometimes people will ask me, gee, do I have to look at every K1? Do I have to get a K1 from everyone listed? Well, some of my clients do have a guideline that allows you, if the passive items are relatively small in amount, not to get the K1s. That is a guideline issue. I am not setting your guidelines, can't set your guidelines, but at least I can give you an idea of what possibilities there are. So for me, if I was making your guidelines, I would be getting the non-passive and I'd be considering the passive depending on their impact, but also your sense of whether in the investment side, maybe they're a real estate developer and it's very likely they've got call provisions in some of these. So it really does depend on your borrower and your guidelines. See what else we got on this one. Difference between passive and non-passive, and does it influence cash flow of the borrower? The influence I believe, is how likely is it to be a large influence, number one, and number two, how much control does the person have over what they put in or take out from that entity. But you can have cash flow happening on either side, passive or non-passive.